Welcome back to our class. In this video, we will continue with our discussion on securitization in the real estate market by looking at real estate investment trusts, or REITs. Before we go into details, I'd like to introduce you the four-quadrant real estate market. In the four-quadrant market, there is a private market and a public market, and there are debt type of assets and equity type of assets. And we can use their combinations to form four types of market: private debt market, private equity market, public debt market, and public equity market. And we can classify assets of the real estate market into the four markets. So, can you give me an example of private debt in the real estate market? You probably would already have your answer. A good example of private debt is mortgage loans privately issued by banks to homeowners. And how about private equity? Equity means ownership. So in the real estate market, private equity means people's private home ownership. Next, how about public debt, or that type of real estate asset traded as securities in the capital markets? The answer should be mortgage-backed securities, or MBS. Okay, and how about the last category, public equity, or public ownership of real estate in the form of securities? The last category is REITs, or equity REITs in particular. There is another type of REIT called mortgage REITs, whose main business is to issue real estate-related loans. The U.S. market is dominated by equity REITs. So, REITs are equity in the form of public securities. But why does the market lead public real estate in the form of REITs? The first reason is that real estate assets are bulky. Traditionally, if you want to own a piece of real estate, you probably would have to spend a fortune on it. And the majority of people may never have the chance to own a commercial real estate. With securitization, ownership of real estate can be divided into thousands and millions of standard securities in the form of REIT shares. And investors can own one piece of real estate now. So, REITs provide equal opportunity for smaller investors to participate in real estate ownership. The second reason is that real estate assets are local. Traditionally, if you live in one city, it will not be feasible for you to lease and manage properties in another city. That securitization allows investors to conveniently own a portfolio of real estate all over the world. Thirdly, properties of REITs are managed by professional real estate managers, and there is also value creation in professional real estate asset management. In the U.S., REITs take the form of companies. According to U.S. SEC, a REIT is a company that owns and typically operates income-producing real estate or real estate-related assets. In the U.S., beneficiary units of REITs in the form of company stocks are traded on stock exchanges such as the New York Stock Exchange and NASDAQ. In Asia, REITs can also take the form of a trust. In the U.S., in order to avoid double taxation, REITs are exempted from paying corporate taxes. Investors may pay taxes upon receiving dividends or realizing capital gains. In order to be qualified as a REIT for tax purposes, a real estate operating company must fulfill a set of REIT qualifying tests. As we have discussed, one of the major reasons to set up REITs is to provide equal opportunity for common people to participate in real estate investment. The designs of REIT qualification tests are consistent with this purpose. For example, REITs must have minimum of 100 shareholders after its first year as a REIT, and must have no more than 50% of its shares held by 5 or fewer individuals. They must have shares that are fully transferable, and they must distribute at least 19% of taxable income to shareholders annually as dividend, and they must derive at least 75% of its gross income from real estate-related sources. In essence, REIT qualifying test aims to make sure an incorporated REIT operates in real estate and its shares are open to the public investors. Next, I would like to review the structure of a REIT in the form of a company. An incorporated REIT will be owned by shareholders. A REIT would then own and operate a portfolio of properties for its shareholders. In order to run a REIT, shareholders select a board of directors to act on their behalf. Board of directors is in charge of appointing senior management to run the REIT. REIT managers would decide on major corporate events such as property acquisition and dispositions. REIT managers also appoint property managers to take responsibility of managing properties. These properties generate revenue in the form of rent. Revenue will be used to cover operating expenses and fees to board of directors, REIT managers, and property managers, and the net income of a REIT will be distributed to shareholders. A REIT can also take the form of a trust. Investors will be trust unit holders in this case. In the market of China, there is still no public real estate equity market. There are some products claimed to be real estate investment trusts or REITs that are usually fixed income in nature. I would like to refer these alternative products as alt-REIT assets, short for alternative REIT assets. Our first example is real estate trust project. This type of project is usually initiated by a real estate developer who is in need of financing. A developer would first approach a trust company. A trust company would set up a trust project and sell beneficiary units to investors. A principal investor will provide funding. The trust company collects funding and provides liquidity to the real estate developer. Collaterals are usually required in the funding process. The real estate developer then develops and sells real estate projects and uses its generated revenue to repay the principal and interest to beneficiaries of the project. We can see a real estate trust project is very different from a typical REIT in that the starting purpose of this trust project is financing needs of a developer. It does not help an investor to own a portfolio of real estate. Next, it is a fixed income product that specifies a given expected return, and collaterals are often used. Also, beneficial rights cannot be freely transferred on the open market. In addition, the developer builds and sells to make a profit, but a typical REIT would build and operate to generate least income. And we can see this type of product is private debt in nature. The next example of an alt-REIT is Vanke Shanghai REIT. The project was sponsored by Vanke, the largest real estate developer in China. The project was designed as a closed-ended fund managed by Penghua Fund Management. The fund was open to public investors. Part of the invested fund will be spent on 8 years of beneficiary right to list income of Vanke Shanghai Gongguan Construction and Management Company, which is a subsidiary of Vanke in charge of leasing properties located in Shanghai of Shenzhen City. By end of year 2023, the fund's share of the above Vanke subsidiary will be repurchased by Vanke. This project also differs from a typical REIT. First, although the fund can enjoy leased income generated by Vanke's properties for 8 years. The fund does not own the properties because the fund has no ownership. It can hardly take advantage of increases in property prices during its holding period. Next, real estate only accounts for less than 15% of the fund. Actually, the largest asset category of this fund is bond. In comparison, a typical REIT would have a majority of its assets in real estate and generate a majority of its income from real estate operations. In addition, they can promise to back up the return of this product against an annual return of 1.5% above a 10-year government bond. This design makes this product a hybrid of debt and equity in nature. Okay, in this video, we have learned about REITs and the public real estate equity market. And we have discussed outright product in China. Thanks for watching and see you next week.